Hello, everybody. Welcome to another Taxes and Retirement Live. I am your host, Andy Panko. Yes, I'm wearing a fun hat today. And in doing so, I probably lost any shred of respect he may have had for me. Why the hat? Well, partly because I want to look like a wizard or a Merlin, but also, more importantly, this is the 1 year anniversary / birthday party, if you will, of me doing these weekly Taxes and Retirement Lives. I did the first one. It was actually June 17th, not June 16th, but it was this Wednesday a year ago. And the first topic was the super exciting topic of how Social Security benefits are taxed. I know, right? That one brought down the house. So anyway, so here we are, a year later, one fun hat extra. Lots of change. I like to think for the better. I started doing these videos super sort of technical, nerdy, deep dive into things like Social Security taxation. Yes, I filled the whole 45 minutes or hour about that one. And then along the way, as you can tell, the topics have broadened out. This group is no longer just taxes and retirement. It's more sort of still tax focused, but other kind of general retirement financial planning stuff, which hopefully is all resonating with you all. And these videos have I like to think, gotten better. It started off me with just a camera and holding up, slides in front of it for graphs and things like that. Now I have this software where I can do these neat overlays like this and things like that. So anyway, taxes and retirement has kind of grown up in the last year. Hopefully you are all enjoying it and enjoy it for weeks and years to come. All right, so tonight we have another mailbag, Ask Andy Anything. I did receive, I think it is 5 great questions ahead of time that I will go through. First, let me do the dad jokes and then the disclaimer. So the jokes for tonight are, give me a second. Okay. First, my dad told me his password is Mickey, Minnie, Goofy, Donald, Pluto, Huey, Louie, Dewey, Dublin. Because he was told this password had to contain 8 characters and at least 1 capital. I like that. Get it? Dublin's the capital there. Dewey's not the capital. Therapist says, what brings you in today? I say, I have terrible fear of tsunamis. Therapist says, how bad is it? I say, it comes in waves. Tsunamis. I'm always freaked out by watching movies about tsunamis, like Deep Impact and stuff like that, where, large wave knocks over Manhattan. And finally, my wife has accused me of stealing her thesaurus. Not only was I shocked, I was also aghast, appalled, and dismayed. Get it? Because the thesaurus is a book about words that mean other words. All right. Disclaimer. Here we go. This video is only general explanations and education. It is not specific tax, legal, investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, investment advisor, which I am not. I'm just some random bloke here answering questions on Facebook, providing general helpful hints and education. All right, let's see what kind of comments we got here. All right, so comments are working. Good. I like it. All right, I will, without further ado, I will get right into it. As always with these mailbags, I just ask, for you all watching at home, when someone asks a question, if you can just refrain from answering it in the post, let me get it. Not that I'm trying to steal your thunder, but it's just hard for me to sift through the comments because the software I have doesn't nest. When one comment is replied to another, they all just show up as if they're their own comment. So I can't tell who already addressed what and things like that. So anyway, I will go through the 5 questions I already have, and then feel free to plop whatever other questions you have in the comments of the video. So let's get to it. First one from Dolores Fa, F.A. My question is about gifting. How can a couple gift $30,000 to a child without having to do any IRS paperwork? Can we transfer 2 $15,000 gifts from a joint checking account, or must we give from separate individual checking accounts? Thank you so much for all the detail. Okay, so great question, Dolores. And yes, now I can't say it's with 100% certainty, but from what I've read from multiple seemingly reputable sources, none directly from the IRS, but nonetheless other places and people that I trust that seem to know what they're talking about. A married couple. So each person in the couple can only give up to $15,000 per year to any single recipient. When you're married, you can each give 15. But the trick here is that even if it is a joint account, you can give money from a joint account, but it would need to be 2 separate checks. So each you and your spouse separately give a $15,000 check to who's heir to your child. It's okay to be from the joint checking account. It does not need to be from two separate accounts. That's my understanding. And the reason is, even with any gift, even if you're married, there can only technically be one donor, one gifter, even for jointly married couples. So if you were to give $30,000 from a joint account, you may sort of by default think, well, it's joint assets, so it's inferred that half of that $30,000 is from me, half is from my spouse. That's not the case. There can only be one legal donor. So that $30,000 is technically coming just from you if you send it, even though it's from a joint account. So joint account's fine. Just split it up into two separate $15,000 payments. And just to recap for other people watching, why $15,000? Well, that is the annual exclusion limit, gifting exclusion limit, where you can give up to $15,000 to as many people as you want in the world, and there's zero reporting, tax work, tax return work, or taxes or anything. Once you exceed giving more than $15,000 to a single person in a year, and that $15,000 limit changes a little bit over time, but in 2021 it's $15,000. Once you give more than $15,000 to any single recipient, person, non-charity in a year, then you need to file a gift tax return. You likely won't owe taxes, but you nonetheless have to report it. All right, great question, Dolores. Hopefully they answered it thoroughly. Next, from David Fultz, the Jedi. Congrats on your 1-year anniversary. Thank you, David Fultz. Here's my question. Would you discuss the difference between using a probability-based approach to deciding important financial areas such as safe withdrawal rates and when to do conversions versus one in which you use computational power to arrive at exact answers? Thanks, Maestro. Maestro, I like that. So, I'll cut right to the end. There are no exact answers in virtually any of this. There aren't exact answers, especially when we're doing longer term projections, distributions. I say it before, I say it all the time, but it's so painfully true. There's so many variables that will change over time. Things like your own mortality, when you're going to pass, or not necessarily just outright die, but health events or other things like that. Other general family considerations. Unfortunately, divorce, death of a spouse, illness of a child, adult child moving home, that all impacts your plans. Tax legislation, right? That will change. We know that. We don't know exactly when or by how much or whatever, but that will change. Financial market returns. What are the stock and bond markets going to do and when? Nobody knows. Inflation, what's that going to do? So not to say you shouldn't try to use good software, statistical analysis, partly not relying on the past, but partly using the past as at least a kind of rough gauge for what may potentially happen in the future, things like that. But you can't get too precise. And that's a tough thing to say to real quantitative, technical-minded folks like engineers, mathematicians, whatever, when doing retirement planning or things like that, because their nature is to want an exact answer. Tell me precisely how much to withdraw, or things like that. Tell me exactly how long my money is going to last, and we simply can't, right? Again, not that you shouldn't try with things like Monte Carlo analysis, which is heavy in the computational power, but that's just one data point that's literally trying to kind of predict the future, which we know is to some extent futile, right? At least to do it with certainty. So for what it's worth, I think a combination of all those things, safe withdrawal rates, like rules of thumb, like the 4% rule, decent starting point. You by no means should build a financial plan around just the 4% rule, but it's nonetheless a decent litmus test as a starting point. Monte Carlo is another great one. That's a computational power coming into play. And then any sort of combination of other things you may have read about guardrails and bumpers and sort of dynamic withdrawal strategies and things like that. I just lost my train of thought. So right. Here's what I meant to say. There's no single right or perfect withdrawal strategy or approach. I think the best way is really a combination of these things. Realize you can't map this out with precision and certainty because we're projecting 30, 40 years with lots of unknowns that will play out over time. So you have to kind of pick something that sounds logical, that looks logical based on the best assumptions and guesses and projections you can do now, but realize it will change. Even the best financial plan will get outdated, will be stale, will be wrong as life and things evolve around us. So you have to stay agile, kind of roll with the punches, as they say. There's really no way to completely de-risk and take all the variables out of retirement or distribution planning. The only way you sort of can, and even this is far from bulletproof, is if you were to plop every single dollar you have in fixed annuities, then you know with certainty what your income is going to be every year for the rest of your life. But what you don't know is what your expenses are going to be, what inflation is going to be, how long you're going to live. So even that guaranteed income, 100% guaranteed income, is still far from foolproof. Hopefully that answered your question. It was a little bit of rambling, but that's just kind of me trying to put my thoughts on paper about that. There is no single or right or best answer to that question, but it is a great question, Dave Holtz. Thank you. Next, I'll save this one for last because that one's fun. Next, Gail Aiken asks, one of your latest topics was the 4% rule. Question: using that same $1 million portfolio, what if your retirement plan requires you withdrawing various amounts during your retirement, not 4% or $40,000? Example: say from ages 62 to 70, you need $50,000 from the portfolio per year, and from 71 on, you need $20,000 per year from the portfolio. Would love to hear your thoughts on the best way to look at situations like this. So this kind of dovetails, great question, Gail. This kind of folds into what I just mentioned with Dave Holtz. The 4% rule, far from perfect. It's just a super, super dumbed down, back of the envelope sort of litmus test, I like to call it, to see for the amount of portfolio withdrawals you roughly anticipate having, is your portfolio within the realm of reasonably large enough to make that work. So for example, $1 million portfolio, 4% rule says you can safely withdraw $40,000 per year to begin in retirement and increase that every year for inflation. And historically speaking, there's a negligible chance of that running out of money. Now, practically, 4% is actually a lot more times than not too conservative. If you look back over the last various series of 30-ish years, you could have withdrawn more than 4% per year and still be fine. It's just in the worst string of 30 years over the last 75-ish years or so, which is what the 4% rule tested, 4% was the highest amount you can, 4% was the highest you can take out and not deplete in any of those 30 years. But under most of those 30-year periods, the amount you could have taken out was actually much higher than 4%. So where am I going with that? Life isn't linear. Spending isn't linear. While the 4% rule looks decent on paper, you shouldn't necessarily pigeonhole yourself to only spending 4% of your portfolio in that first year plus inflation thereafter. Spending will be lumpy. Life will be lumpy, right? There's the go-go, slow-go, and no-go years. The go-go years are the first 5-ish to 10 years of retirement, where you're still hopefully very fit mind and body. You can travel, you can be active, you can go do stuff. You'll logically kind of spend more on fun and discretionary stuff in those go-go years. Then that's followed by the slow-go years. Things start to slow down, right? Maybe your body starts kind of giving out a little, slowing down a little bit. Maybe your mind starts slowing down a little bit. So you're not doing as much, you're not spending as much, you're not traveling on exotic, physically active places. So your discretionary spending probably comes down some. And then the no-go years, that's where kind of, one extreme, you're completely bedridden or close to it, where you're not really doing much. You're paying for basic life, and your healthcare expenses are going to be higher at that point. But generally, I think a lot of people end up spending less as they progress through retirement. More in the early years, less in the later years. So how do you figure out how much to take out? That's where I say you got to be agile. This is always kind of a moving target. Don't limit yourself to 4% in those early years. Spend a little more. Have fun while you can. Just realize you'll likely, possibly need to cut that back a little bit over time. Because you can't necessarily take out 10% of your portfolio every year, because that almost certainly will deplete it in your lifetime, especially if you live 20, 30 years. So be flexible, be agile. Yes, you can take more in the first few years. Just sort of pay attention, over time. If there's a real bad string of multiple bad years of stock returns or bond returns in your portfolio gets crushed, then you kind of have to rein it in a little bit. Otherwise, if the stock market continues just unabashedly going up, you can keep spending more and more every year, because the market growth is probably more than covering your withdrawals. So great question, Gail. Hopefully that answered it. General question from Anwisha about rentals. Now, it wasn't general. She gave me a very specific, detailed set of questions and numbers about things that I figured that's a whole, that's way too granular to do tonight. But let me touch on some of the topics she brought up about rentals. So generally, now the tax implications of rentals could get quite hairy, especially if it's a property you previously lived in as your primary residence, or will live in as your primary residence, or split between renting it and living it as your primary residence. So I'm not going to go too far down that rabbit hole. But the gist is, when you have a rental, it's in effect a business, and the expenses associated with the business are deductible. Things like mortgage interest, things like utilities, things like maintenance, getting the grass cut, things like property taxes you pay on it, all that stuff. Even depreciation. And I did a video on rentals. It's all sort of, all the basics of this are hashed out there. So depreciation can be deducted as an expense. Now, you can't not have income. You can't not have rental income and deduct those things, or at least I should take that back. You can't start deducting expenses until you officially put the property, quote unquote, in service. So just because you buy a second property and you say, yeah, I'm going to rent it out, it doesn't mean you can start deducting expenses right off the bat. You have to actually put it in service. That means you need to make a good faith effort to put it out to the world to say, hey, this is ready to be rented. It's able to receive tenants at this point, right? So that means you have to advertise it, whether it's Craigslist or newspaper or whatever. You have to actually make an effort to find a tenant in it. Once you start making that effort, then it's in service. Then you can start deducting expenses against it, even if you don't have any income. So let's say it sits empty for the first 2 months that you start advertising it without a tenant. You can deduct those 2 months of expenses, even though there's no income yet. Now, what happens if you have more expenses and deductions than you do rental income for the year? Can those expense deductions help reduce the rest of your taxable income, like your wages or whatever? And the answer is maybe. At lower levels of total income, yes, net expenses, net deductions you have from a rental property can help bring down the rest of your taxable income. But once you're over a certain level of income, I forget what it is, it's like 150,000-ish maybe, then you can't deduct that year's net rental losses or expenses against other income. But it's not lost forever. Once you eventually sell the place, then those losses keep carrying over year by year and can be deducted against future year's rental income. But once you eventually sell the place, if you still have batched up unused expenses, then you can take the deduction at the time when you sell it. I'll leave it there, and we should hopefully that sort of helped and sort of answered what you were getting at. Again, it was too specific, too detailed of a very precise scenario for me to address here, but I will I'll probably do a live just about rentals at some point, because it seems a lot of people have questions about it. All right, and finally, question from Canon about SPACs, SPAC, Special Purpose Acquisition Company. So question is, can you discuss SPACs, Special Purpose Acquisition Company? Is there a role for SPACs in your retirement portfolio? What are the pros and cons for the average investor? How does one participate in a SPAC? Is there a minimum guaranteed return on these investments? Definitely not. Thanks. So, okay, great question. Very current event, topically relevant, because you probably have seen or heard buzz about SPACs in the last year or two. Let me start from the beginning. So a SPAC is otherwise known as a blank check company. And what it is a shell company that goes public by way of an IPO, initial public offering, just sort of like a normal company would go public with a stock. But a SPAC, when it goes public, it's a blank check company, like I said, because all it does is it raises a pot of cash from all the people who buy the IPO, and that's it. From that point, for the potential, for a year or two, up to a year or two generally, that company is nothing more than a shell company that owns a pot of cash. That pot of cash is put into a trust, and it just sits there. I think it's technically invested in like government bonds or something to get some interest, but it just sits there. The purpose of the SPAC is the people who manage it, the people who run it, who create it, which are typically private equity veterans or previously company executives, people who have some sort of experience and knowledge in buying and managing companies. They're the ones who create these SPACs. So you buy this SPAC, and then I think it's generally a year or two. The SPAC manager has a year or two to take the cash raised from the IPO and go use it to buy and take public some private company or merge with another company. It's a little out there. So what do you buy when you buy a SPAC? So a SPAC, again, it's a pot of cash. There's nothing to it. The price of that SPAC should be pretty flat, shouldn't change much, because the value is just the cash belying that SPAC. And then at some point, again, generally up to a year or two, the manager of that SPAC will go out and will find a company that he or she wants to buy, a private company he or she wants to take public. And so what happens is the cash in that SPAC is used to go buy that private company. And in doing so, that private company now that was already in operation, it's, for however many years they've been around, that private company now kind of takes the place of the stock, of the SPAC stock that was already being traded on whatever exchange. New York Stock Exchange didn't start listing SPACs until 2017, I think, or thereabouts. This will all make sense. There's a few different thoughts I have all going to converge at the same time. So once that merger or acquisition is consummated, then the SPAC that you had, which was again just a pot of cash that wasn't doing anything, now becomes whatever company was purchased. And that SPAC stock from that point forward will be stock of that company that was purchased. And then it'll go up or go down just like any, company stock does. So here's my thoughts about these. The SEC is starting to want to crack down on them. So 2019, 2020 were huge years for SPACs going public. I think it was 300 to 400 new SPACs each year. In the years prior, it was only a few dozen SPACs each year. From like the crisis up until 2018, it was a few dozen SPACs per year, if not less than that in some years. Here's why SPACs are potentially dangerous. When a company goes public via the traditional IPO route, there's a long, drawn-out vetting process where investment banks and investors at large get to kick the tires on the company, get to look at its financial statements from the past. That company is not allowed to make projections about what it anticipates its revenue or its profitability to be going forward. That's up to the Wall Street and the analyst community to figure out for themselves what do they think this company may eventually do in the future. So there's much more sort of diligence that goes into it. So by the time you, the retail investor, buys a company that IPO'd via the traditional route, you, for the most part, know it was well vetted, that the professionals did their diligence, that the price of the company should hopefully be reasonably set based on the actual potential economics and health of that company, et cetera. When you buy a SPAC, the SPAC greatly sort of circumvents all that traditional IPO process. So the SPAC goes public. There's really nothing to discuss. It's just a pot of cash. There's no results. There's no company to talk about. So the IPO process for the SPAC is really just based on sort of the credentials and the faith that the IPO purchasers put in the manager behind the SPAC, the individuals who you are banking on to take this pot of money and eventually go buy some company and hopefully it turns profitable for shareholders. That's what you're betting on in a SPAC IPO is the manager behind the SPAC. You don't know what company it is yet. It's just a pot of cash. So when that IPO first happens, the diligence is pretty loose because there's not much to diligence. There's no company again. It's just a pot of cash. When the SPAC does eventually buy some other private company, the diligence around that is much less than what the diligence would have been if that company directly went public through the traditional IPO route. That's because the Wall Street analysts don't have to vet it or anything like that. It's just the SPAC manager can in effect buy whatever company they want with the SPAC, no matter how good or how bad. And they can make projections to the world, which traditional IPO route doesn't allow. So they can project, hey, this company we plan on buying, we forecast it's going to have revenues of X every year and profits of Y every year. Well, they may not turn out to be the case, right? So not to say people intentionally fudge it. I mean, they may, but it's easier to make a SPAC purchasing a private company, make that private company look rosier than if that company went IPO through traditional route. One other thing I don't particularly like about it is the people who set up the SPACs, the managers behind it. They can buy up to 20% of the IPO at significantly discounted prices so that when they eventually do take the SPAC cash and buy a private company, they get really large financial return from that. So you can say there's sort of an incentive for them just to go out and buy whatever piece of junk company because they're going to get a fat payday from it. The flip side of that is no, well, the manager's taking on a lot of risk with this and a lot of work, and sure they are. So what's the right way to view that? I don't know, but there's definitely a lot of money to be made by the people who start these SPACs. And that money is potentially, at the expense of you, the shareholder who goes out, the retail sucker who goes out and buys this. So to try to answer your question, Kenan, are they good or bad for retirees? It all depends. It's like any other single stock. I don't advocate stock picking. I don't say any single company is good or bad per se. I'm an index ETF guy. A SPAC is basically a single company, individual company, but with the added unique risk that initially it's just a pot of cash, and when you buy that pot of cash, you have no idea what company it's ultimately going to acquire or merge with. So it's a huge kind of gamble. You're betting on the SPAC manager that he or she is going to pick some winner of a company down the road. So therefore, it could be potentially riskier. Reward could be quite high, but risk could be substantial with that. So that's my thoughts on that. How do you buy it? I believe Robinhood might actually let you get in on the SPAC IPO. Generally, SPACs all IPO at $10 a share. And again, they don't move much because it's just a pot of cash, initially. It's not until there's buzz in the market that the SPAC actually has a target it wants to buy, then the price of that SPAC starts moving around. So I'll stop there. I can kind of ramble for all night about this. These are really unique animals. I don't know that it's good or bad. Just, be eyes wide open getting into it, Ken, when you're interested in considering a SPAC. All right, that is all for the pre-canned questions. Great questions, everyone. Thank you. Let me now scroll to what we got here from the users. Okay. Can small charities open up brokerage accounts to accept stock gifts from their donors? Are there any rules on that? I assume so. So not all charities have an associated brokerage account. So like people I work with, clients I work with sometimes have highly appreciated securities that they don't particularly want or need, but there's a large gain that they don't want to have to, realize if and when they sell. So you can just gift those shares away to some charity. The problem is not all charities are set up to take in securities. They don't have a brokerage account, especially the smaller ones, right? They're just not that robust. So I don't think that's to say they can't get connected with a broker and have some sort of brokerage account. I think a lot of them just simply don't bother. So anyway, so if you're a charity, if you run a charity, my guess is you probably can. I don't know the specifics around how you do it and what's involved, but presumably you can. And let's leave it at that. But it may not be worth the cost and effort and administration to do it, especially if you don't plan on getting a lot of security-based donations. But great question. Andy, is there any difference between a 403B Roth and a regular Roth backdoor Roth? Okay, so let's throw out backdoor Roth for now. So Roth isn't a specific account. Roth is just a type of account. Specifically, it's a tax classification of how accounts are treated. Roth just simply means the money that goes into the account is already taxed prior to going in. And then when that money comes out, it is all tax-free, assuming you meet a few different conditions, which I won't touch on here because that's a whole other half-hour tangent. But accounts of different types could all be of the Roth status. So you can have an IRA, individual retirement account, can be traditional, or it can be the Roth flavor. Employer plans like 403B can be traditional, meaning you get a tax break on your contributions, but then it's all taxed, or you get a tax deduction, I should say, on your contributions. The money's all taxed when you come out. Or you can have a Roth flavor 403B where the tax treatment's the opposite. The money goes in after having already paid tax. It simmers and grows tax-free, comes out tax-free. So no, in that sense, there's no difference between a Roth 403B and a Roth IRA or a Roth 401k or a Roth TSP, which is a federal savings plan. They all have the same general tax treatment. Now, what is different is there's different contribution limits. Like 403Bs have different contribution limits than IRAs, but that's not Roth specific. It's just 403B versus IRA specific. Hopefully that makes sense. Now, backdoor Roth isn't a special type of Roth. It's just simply a Roth IRA generally, where the money you got into it was by way of the quote unquote backdoor. You first contributed it to a traditional IRA, then immediately convert it to the Roth IRA. Hence, the money got into the Roth IRA via the backdoor, i.e. the traditional IRA. So backdoor Roth isn't its own special account. It's just a Roth IRA. Backdoor refers to how the money got into it. Does that make sense? Whoever posted this. Kenan, presumably about the gift question. What if you write 10 $3,000 checks to a child to stay below the $30,000 exclusion tax limit? So again, it depends who it comes from. Let's assume you're married, Kenan. You can only write 5 $3,000 checks to your one child. That would keep you below your $15,000 limit. Your spouse can separately write 5 $3,000 checks to that same child. So your spouse then stays below his or her $15,000 limit. 30,000. There's no magic to 30,000 for a married couple. It's just simply each of your individual 15,000 limits added up to 30. Does that make sense, Ken? So the number of checks doesn't matter whether you write one $15,000 check or 15,000 $1 checks. It's still $15,000 that you're gifting, so long as you don't exceed the 15,000 to one recipient. That's your, within your annual gift exclusion. Okay. Yeah, so David Myers is presumably just commenting about that question about using high-powered computational tools versus kind of rules of thumb for distribution planning and other things and tax planning. It's impossible to predict the future with accuracy, but doesn't mean we shouldn't try. Just realize there is no finite answer to doing tax projections or mutual fund or stock or bond return projections, because who knows what's going to happen. All right, thank you, David Myers. Okay, sorry, just looking at what else we got here. If you have never taken a depreciation deduction on a rental, when it is sold, will the IRS still recapture the depreciation even though you never took it? Yes, that's a big fat gotcha. So briefly, again, depreciation on a rental looks like magic, looks like a free gift when you own the rental because it's a non-cash expense. You don't have to pay. Depreciation just sort of happens. The value of the property you bought, you can deduct a portion of its value every year for 27 and a half years typically. That's depreciation. So it looks like a freebie. You're getting a deduction for something you didn't actually have to lay out cash for year by year. Sounds great, right? But when you go to sell the place, all that depreciation you expensed along the way will come back to bite you, because all that depreciation you now have to pay ordinary income tax on, up to only 25%, I believe, when you do eventually sell it. So you thought you were getting freebies along the way, just to find out, oops, you kind of have to pay it all back and pay tax on it when you eventually sell the joint. Now, this question is that you may ask, well, what if I don't take the deductions year by year? Well, does that mean I don't have to pay tax on recapturing that depreciation when I sell the place? No, not that simple. Even if you don't take the deductions, the IRS will still tax you when you sell the place as if you did take the deductions along the way. So if you own a rental, don't skip out taking the deductions thinking you're going to save tax on the back end, because you won't. You're going to have to pay that tax on the back end regardless. So take those deductions year by year, because you're leaving money on the table if you don't. Good question. Congrats and awesome shirt. Thank you, Wu-Tang Clan. All right, Brian Williams. Next, Sandra Rutherford. Hopefully this is fairly generic. It looks like I'm going to do some temp work soon as a 1099 contractor for a company. I'm retired, 60. Income is currently solely from IRA 401k. The job is tentatively 2 to 3 months. So the income, oh man, I can't see this whole thing. Sorry, it's getting cut off. Hopefully this covers it all. But so the income will likely simply offset what I would have withdrawn from my retirement funds. I'm wondering if there's any benefit to setting up a new retirement vehicle for 1099 income. If so, which of the vehicles might be best? Okay, I see where you're going with this. So hopefully what I can't see here isn't anything of too much substance. Sure, if you have self-employment income, you can set up a small employer plan, like a SEP IRA, SEP, like a simple IRA, like a solo 401k. I can't say whether or not you should or what would be best. That there's too many other things to consider and discussions to have around what your plans are, what your other resources are, what your tax projections are to say it. But if you want and need to save extra money, sure, opening up a small retirement vehicle could make sense. And depending how much money you're going to be making, if it's only going to be under the $7,000 IRA contribution limit, then maybe you don't need to bother opening up a separate plan, right? You can just put up to $7,000 into IRA, Roth IRA each year. So maybe you just do that. If you're going to be making more than that and want to save more than that, then you would need to consider the SEP IRA, the simple IRA, or a solo 401k. But again, I can't say what would be best. Good question, though. Canon. Chamath. Oh, yeah, I can't pronounce the name. I know who you're talking about. We'll just call him Chamath. Chamath was on CNBC talking about his SPACs, and that's what made me think about them. He seemed to indicate that SPACs could drive some unique growth. Thanks for the explanation. Obviously, we only hear about the successful SPACs, not the ones that fail because they didn't pick up a good company to buy. Yeah, so this person you're mentioning, I think his SPAC was the one that bought Virgin Galactica or whatever, Richard Branson's spaceship company. So this is one of the more higher profile, more publicly noticed SPACs. And I think it has done well. So good for him. But there's also SPACs that have gone quite wrong. Like there's a SPAC that bought Nikola. So you all know what Tesla is, right? Tesla is the electric car maker. There's a company called Nikola, Nikola, that makes electric trucks, like 18-wheeler rigs trucks. And it was a private company. It wasn't really much more than proof of concept. I think they had one like test model or something like that, but there was no mass production or I don't think much, if any, sales, if I remember correctly. But a SPAC bought it, took Nikola, which was private, took it public. So the SPAC shares became shares of Nikola. So anyone who bought that SPAC initially bought a pot of cash. Now they own shares of Nikola. And guess what? The projections that the SPAC and that Nikola gave during this SPAC acquisition of Nikola, those projections were overly rosy, and it ends up things didn't quite turn out. After people started digging behind the scenes of Nikola, realized I don't think there's as much here as they said there would be, or potentially fluffed it up to be. So shares of Nikola went up like 600% from the original blank check pot of cash SPAC to when Nikola was bought, and I think it dropped, gave most of that back. It still may be up roughly double from where the SPAC was initially purchased, last I checked. But anyway, that in my mind, that's one example of a SPAC. I don't want to say gone wrong, but that's one of the big risks of a SPAC. A company that kind of may have fudged or fluffed its books would have never cut the mustard, having gone the traditional IPO route, because the Wall Street banks and analysts would have torn it apart and realized, this company doesn't have much going for it. But since it went public through the SPAC route, it was able to put out there these rosy projections to the world that people bought into, and everything looked great, and ends up that didn't quite turn out that way. So anyway, I'll stop there on SPACs. Is there any disadvantage, Linda, is there any disadvantage to consider in using the once per lifetime HSA to Roth conversion? So I don't think you can do HSA to Roth conversion. I'm assuming, Linda, you may be talking about the once in a lifetime IRA to HSA contribution, where you can take money only once in your life from your traditional IRA, transfer it into your HSA, and that money leaving your IRA is not taxed. It's not a taxable distribution. It just goes into your HSA from that point forward. As you know, HSA monies are all tax-free if you use it to pay for qualifying medical expenses. I'm guessing that's what you're talking about. I'm not aware of any HSA to Roth process, and I don't know why you would, because the HSA is already more tax advantaged than a Roth anyway, or at least it's as tax advantaged. It's actually more tax advantaged. So anyway, so assuming you're talking about the IRA to HSA transfer, there's not really disadvantage. There's not tremendous amounts of advantages either, because it's a relatively small amount. You can only transfer up to your annual HSA limit, which is like $7,000 or $8,000 this year at most for a family plan plus catch up. So it's not a massive amount of money you can transfer to your HSA that way out of your IRA. Disadvantage wise, I don't really think so. Or if there is, it's on the margins. There's just nothing really, no showstopper. It may not be worth the hassle, the paperwork and the risk of the custodians potentially botching it and giving you wrong 1099 reporting. I've done one or two of these with clients, and it worked out fine, honestly. But yeah, outside of potential sort of operational things going wrong, I don't really think there's any meaningful disadvantage, if any. Okay. Do you think RMDs will change to 75 from age 72? Yes, I believe they will. It seems like a pretty innocuous change. It seems like there's already bipartisan support for this. The Secure Act 2, it's called, colloquially called. I forget the actual name of the bill. But it seems to be pretty well supported. And the way it's going to work is it wouldn't go straight from 72 to 75. There's going to be a phase out period. Or phase in, I guess you would say. I forget the specific years, but starting in 2022, I think, if you're not already 72 by the end of this year, then your RMD age is 73. So if you turn 73 between like 2022 and 2032, I want to say, your RMD is 73, then it goes up a little bit from there. So it's going to be this sort of staggered thing. It's not happening overnight like it did with the Secure Act, where it went from 70 and a half to 72, like, literally overnight. This as currently drafted and thus far supported by Congress, it's going to be this gradual phased in thing from 72 to 75. And I do suspect it will pass, or at least some flavor of this will pass, such that RMD age will get bumped up. That's just my guess. but I don't see reason why it would get squashed at this point. My brother wants to buy the only building lot allocated on the family farm in a trust. We want to wait for a step up in cost basis and sell the whole farm. What tax issues will be involved, if any, if my parents give in to his demand? So your brother wants to buy in a trust. I would need to know more. When you say trust, is it irrevocable, irrevocable? What's the point of the trust? Who's actually buying it? Presumably your brother. If you were to buy it, it would depend the price at which he's buying it versus its market value. If it's something below market value, there may be a gift involved. The difference would be deemed a gift, but it would need to know, more details about this to give any sort of other info. When is better for Roth conversions? While employed in high brackets. When is better for Roth conversions? While employed in high brackets with income? Oh, here we go, part 2. Or after retirement and lower income when income is limited. Yeah, it depends. So all else equal, you'd rather convert when you're in a lower tax situation than not. But now it's tough to say. So like when you say now employed in high brackets with income, what's high? And is high now still going to be high relative to whatever potential tax changes or increases there likely will be down the road? We don't know. It all depends. Without doing a projection and some analysis and looking at your actual facts and figures, it's hard to say. Maybe you should bite the bullet now and convert some while you're in a higher tax rate, or maybe you shouldn't. If you don't have a massively large tax deferred account, then it may not be that big a deal. You can just, sit on it and do it later years when you're in lower income. Tax rates themselves may be higher, but your income will be lower after you stop working, presumably. So can't really say. It really all depends on your situation, but good question. Oh, yeah. David Meyer's getting technical here. So if you do a $30,000 gift from a joint account for a married couple, yes, you can, and there you can do what's called gift splitting, as Dave's mentioning, but you have to file a form for that, where it's more work than is necessary. The gift tax form is a bear. You don't want to do it if you don't have to. You can basically say you can write one check for $30,000 to your kid, and then you can say, hey, that $30,000 is to be split half and half between me and my spouse. Well, you can't just say that. You have to actually file a gift tax return at the end of the year to tell the IRS that's what you did. So just avoid that. Like David's saying, just simply write 2 checks, $15,000 each. Other than having to waste one extra check, it's worth the hassle to avoid the gift tax return. Okay, this is in response to Sandra. All right. My credit union rep told me today that you absolutely can open a Roth IRA without any earned income. The only way I know to do this is if one spouse makes enough to make a spousal contribution for the non-working spouse, is what he said, a case of if it sounds too good to be true. No. So there's a difference between opening an account and funding an account. Anyone can open an account. You don't have to put money in it. You can simply just open an account with zero. The custodian isn't going to challenge you or ask you, hey, did you ever earn income? No, they'll be happy to let you open the account. So yes, anyone could open the account. Furthermore, the custodian that has the account, whether it's Schwab, Fidelity, TD, Vanguard, whatever, they're not going to ask you, if you do try to send in money for a contribution, they're not going to ask you, did you have earned income? That's not their problem. That's between you and the IRS to figure out. If you don't have earned income, you have to pay a penalty on that contribution. That's not the custodians. They completely wash their hands of that. They take no risk for seeing if you have earned income. So yes, they will let you open and fund a Roth IRA or a traditional IRA if you have no earned income. You don't want to do that again because the IRS will, that's who'll have beef with this. But yes, even if you don't have any earned income yourself, if you are married and file a joint return, you can't do this if you file separately. If you're married and file a joint return, the non-working spouse can look to the working spouse's earned income and treat it as their own. So for example, you're not working, your spouse makes $50,000. Both you and your spouse can potentially do the maximum $6,000 or $7,000 per year contribution to your respective IRAs or Roth IRAs. as long as that spouse's earned income is more than the amounts you two combined are contributing, you can do that. So yes, it's not that it sounds too good to be true. What your rep said is accurate. The onus is on you to make sure you're not contributing when you're not eligible to, because that will make for a potentially unwanted surprise at tax return time. Okay. If you could move some of the HSA to a Roth, it could make sense if you were close to death, did not have enough medical expenses to spend it down, and want to leave a Roth to a beneficiary versus HSA because the HSA is taxable to the beneficiary. Yep, good point. Whoever said this. HSA, tremendously the most tax advantage vehicle there is for you while you're alive, or potentially your spouse if your spouse inherits it, but not a great account to leave to someone other than a spouse. Because whoever inherits an HSA from you, all that money becomes taxable to them in the year they inherit it. They have to distribute it out and pay tax on it. So that's not cool. So if you know you're going to be leaving most of your money to someone in the near term, yes, in theory, it would be good to get money out of your HSA into a Roth so that that Roth can go tax-free to your heirs. But I don't know that you can move money from HSA to a Roth in the first place. But I guess that's why you capitalize the could, if it was hypothetically possible. All right. Okay, one more question for what I see. Can you contribute to an IRA before you have earned income in the year if you know that you will have earned income to cover it later in the year? Yes, you can. When you do your tax return, the timing of the earnings versus the contributions don't matter. You can, it's all, as long as it happened within that tax year, it's fine. Take it a step further. Now, I know this isn't what you're asking. You're asking about contributing first, then earning the income. But you can actually make a contribution up to the tax return filing deadline. So like these last couple of years are bad because the tax return deadline was extended. But generally speaking, any income you earn for like 2021, for example, you can wait into a 2021 IRA contribution up until April 15th, 2022, before you file your tax return. The risk with what you're asking here, person, whoever this is that you contribute and then you realize after the fact, for whatever reason, your plans to have income didn't quite manifest themselves, so you end up having no earned income. Then you made an excess contribution and you have to take the contribution out. To the extent there were any gains on that contribution while it was in there, you'll have to pay tax on those gains and 10% early withdrawal penalty if you're under 59.5. So you want to try to avoid that, or at least have really good level of certainty that you will have ample earned income, enough to eventually cover the contribution that you made. Good question. June, can you use HSA money to pay for relatives' medical bills? Potentially. You can't just use it to pay for like a random cousin or random aunt or uncle. What you can use them for, I forget the specifics. Basically, people who are qualified dependents of yours and dependents on your tax return, basically. So like if you have a child living with you, a minor child who's a dependent on your tax return or whatever, sure. Here's kind of the rule of thumb. Any expense that would normally be deductible for you on your tax return, any medical expense that would be deductible on your tax return, is eligible to be paid for with the HSA. So think about it that way, right? If your parent who lives states away and isn't dependent on you or whatever, you can't simply pay for your parents' medical bills with your HSA. That's not going to fly, because you can't pay for your parents' medical expenses and deduct them on your tax return. You can only deduct medical expenses for people who are actually dependents, spouse or dependents of yours on your tax return. So same thing with HSA. Hopefully that makes sense. Conversion from traditional to Roth has to be done by December 31st, not April 15th. That's correct. Even though you can make a contribution to an IRA up until the following year, the tax return deadline, the conversion is only on a calendar year basis, right? So you can't make a 2021 conversion after December 31st, 2021, but you can make a 2021 contribution up until April 15th, 2022. Okay, Facebook user. It was the way my bank rep kept insisting that, yes, we could make Roth contributions. The scenario I gave him was both of us retired, so he technically was correct, but not in the scenario I gave him. Yeah, he or she may not have known. I mean, if the wording was simply, if he or she said, yes, you can open a Roth account, that's 100% accurate. Anyone can open one. Whether or not you're eligible to fund it, completely different story. You know, you or at least your spouse, one of the two of you, needs to have earned income, which is wages or self-employment, to be able to make contributions. Jeff and Sandra, I guess. On the pro rata rule for backdoor Roth, does 401k pre-tax get calculated in the calculation? Is 58,000 2021 max the total amount for under 50, or is 6,000 additional possible? Pro rata. So I think there's a couple different things at play here. So the 58,000 you're referencing that's the total amount of money that can go into an employer retirement plan for you. So that's 58,000 if you're under 50. I think it's 58. Is it 58 and change or whatever? But yeah, let's assume it's 58 plus a $6,000. It is 58,000, yes. Plus the $6,000 catch up. So that 58, that's not just the money you can put in. That's a combination of money you contribute plus what your employer puts in, either through matches or through just voluntary, discretionary, like profit sharing or whatever type arrangements. So at most, no more than 58,000 go into your 401, or 64,000, which is 58 plus 6 if you're 50 or older. That's separate from backdooring. That's just simply how much can go into your 401k. Now, of that 19,500, or if you're 50 or older, 25 and 19, 25 and a half, or is it 6,500 to catch up? Now I'm confusing myself. Whatever. So the 19,500 plus a catch up is what you can directly contribute into your Roth. The rest of that 58,000, you can potentially contribute not to your Roth, but to an after-tax account in your 401k, and then you can convert that after-tax account into your Roth. Now, that's only if your employer allows it. So, where I'm going with this. So the dollar amounts you're referencing don't really play into backdoor or not, or I'm sorry, don't play into pro rata or not. Pro rata just means like how much pre-tax money do you have versus after tax. When you convert it, is that conversion is going to be prorated between how much is pre-tax, how much is after tax, or will they convert just the after-tax amount? But that's irrespective of the dollar limits that you reference here. Hopefully that makes sense. So does that mean we may pay for the healthcare expenses for our adult son with special needs with our HSA since we have guardianship and will continue to claim him? Perhaps, I think. Don't quote me. I mean, I don't know specifics of your tax return and your son's tax dependency on you, but it sounds like your son is a dependent on your tax return. So presumably, yes, you would be able to deduct medical expenses for him, which means, yes, your HSA should be able to be used to reimburse expenses related to your son's needs. I believe that is the answer. Again, I guess it depends technically how the dependency is exactly set up between your son and yourself on your tax return, but sounds like probably yes. Just see Cody here gave some commentary. The HSA can be used to pay for qualified medical expenses incurred by you, your spouse, all dependents who claim on your tax return, any person you could have claimed as a dependent on your return, except that the person for blah, 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 blah. So yes, assuming it's this cut and dry, if your son is in fact a dependent on your tax return, which it sounds like he is, then yes, you should be able to use your HSA to pay for his medical expenses. Okay. Is employer contribution to a defined benefit pension included in the 58,000 limit? No. That's a good question. I don't believe so. I can't. It is not. No. So defined benefit, there's a $230,000 contribution limit from the employer, presumably, I guess. For defined contribution, like a 401k, that limit of 58,000 is independent of how much, if anything, you have contributed to a defined benefit plan. If you're fortunate enough to work for a place that still has a defined benefit plan, traditional pension. So no, separate. Unless, just thinking out loud, I don't know if this is the case. I'm just thinking, if you're your own employer, if you're self-employed, maybe this is where you're coming from. Like you want to open yourself a defined contribution plan and a defined benefit plan, then I don't know. I'm not a small business expert by any means. That feels like there may be some issues there. I don't know. I'm just thinking out loud with that. But generally speaking, no. If you work for someone else, a large employer, the defined contribution limit of 58 is different from the defined benefit limit of 230,000. Okay, put that away. And what is this? I work part-time, less than 500 hours a year. I open a 401k with the company for the match. Am I eligible to contribute to this 401k? I guess the company allows it. Then it's okay. I open a for the match. Am I eligible to contribute to this? Yeah, I don't see why not. So if you're working, whether you work part-time or full-time, so long as you're eligible for the plan, to contribute to the plan, that's it. It's either you're eligible or you're not. To my knowledge, there's no like partial eligibility where you're restricted how much you can contribute. The only sort of limiting factor in your contributions would be your total gross wages from them. You can't contribute to your 401k more than you earn. So if you're only earning $10,000 a year, you can only contribute $10,000 on your own. Your employer can separately match or put discretionary money in, but your contribution can't exceed your earnings. Now, I'm guessing this may not be the case since you're part-time, but there's something called, it's not fairness test. What is it? I'm drawing a blank. If you are a highly compensated employee in a company, there are rules. The name's escaping me. There are rules about how much you can contribute. So if like the lower paid rank and file employees aren't contributing up to a certain amount, the higher paid executives and higher earners can't contribute the full amount. So they'll means testing, no, just discrimination testing, I think it's called. So the point is the IRS doesn't want like employers to open plans where just the high paid fat cats take full advantage and pump a lot of money in if the lower sort of rank and file employees aren't also contributing. There's discrimination testing, which will limit how much as highly paid people can put in if the lower paid people aren't putting in a certain amount. So, that's one time where you may be limited how much you can contribute. But if you're only working part-time, you're not going to be on that, presumably not on that high earner end. You're going to be the lower end. So you shouldn't have to worry about getting knocked out because of the discrimination testing. Yeah, David Fultz, well said. Defined benefit plans, especially if you're trying to set one up yourself, like your own employer, defined benefit plans could be a great way to stash away a lot of money each year. But there's a lot more to it, and I'm far from an expert, so I'm not going to comment on it. But yeah, like Dave said, you really need to work with a specialist. Top heavy testing, that's it. With these 401k plans, I think it's also might be called discrimination testing, but you can't discriminate. The plan can't only be used by the high paid people. Or maybe I'm making that up. I definitely heard top heavy as well. Thanks, Dave. A question for Judy. Yeah, so an employer match almost always requires you contribute in order to match it. If you contribute 3%, they may match 3%, but they won't match 5%. Yeah, right. So match by definition is match means they only match money you put in. Separately, the company can do a discretionary, which some companies do, regardless how much you do or don't put in. The company makes sort of profit share, in essence, some discretionary amount of money they put in there for you. But a match, kind of by definition, means you have to put money in to get matched contributions from your employer. Okay, looks like that is it for the questions. I will hang out another 20 seconds or so. Maybe I'll whistle a little tune, kill some time, see if anything else comes in. But otherwise, this is it. Next week topic, it should be interesting. It's going to be bond math. So how bonds are priced, how they're valued, why bond prices change. I'll make a little spreadsheet to show it how it all works. I'm expecting the viewership will be much lower, but probably those that do attend will be super engaged. It'll be the nerdiest of you all who are interested in bond math and how to value and price bonds. That'll be next week's topic. Curious to see how that goes. That'll definitely be the nerdiest, wonkiest topic we've done, most specific as well. But I'm looking forward to it. I used to teach analysis of fixed income for the MBA program at Rutgers, so this is kind of near and dear to me. I'm a little rusty, haven't done it in a handful of years, but nonetheless, I like bonds. Okay, looks like that is it. No other comments, just some thank yous. David Myers, remind me to tell you about my career before I started my shop. Yeah, sounds good. Hopefully it was Bond related, or maybe you were like a spy, like James Bond, David Bond. All right, that's it. Thanks for joining. I will see you all next week for bonds and bond math. Have a good week.